This house in Seattle, Washington is listed at $650,000, and we're going to walk through a real mortgage quote to talk about what the numbers would be if you were the one buying this house. How much would your monthly payment be? How much cash would you need to bring all in between your closing costs and your down payment? And how much income would it take to qualify for the loan? Because I know when you're early in the process of looking for a house, it's hard to get a sense of what the numbers might actually be. So hopefully looking at a real quote will just give you a little bit more confidence early in the process. So let's get started and look at the numbers. All right, I've created two different quotes here, one with a 5% down payment and one with a 25% down payment. So hopefully just comparing the two, even if you're not in that exact situation, you'll be able to get a reference for how the numbers change. And then I am assuming a 740 credit score as I'm creating these quotes. This is a real quote that I'm pulling. My name is Landon Buto. I work with Cleveland Street Mortgage. We're a mortgage broker based in Bothell, Washington. So this is a real quote we've pulled on this house. It doesn't mean it's going to be the exact pricing you would end up with, the exact interest rate, but it's going to vary depending on the day and depending on your exact income and credit score and all of that. But it is real numbers and should give you a reliable sense of what to expect, even if it changes slightly. We'll walk through the 5% down scenario first and then come back through the 25% and see how the numbers change. So the monthly payment on the 5% down scenario is $4,945. And that's made of four different components. The first here is the homeowner's insurance of $150 per month. Homeowner's insurance will vary depending on who your insurance provider is and how much you're getting covered, but that is a common number. So that's an estimate, but it is a common number that we see for this price point and for this area. So that should be a pretty reliable number. Taxes of $486 per month. That's the actual number drawn from the county website for this property for 2024. So that one is the actual number. That's not going to change. Mortgage insurance of $149 per month. You're probably familiar with mortgage insurance, that you have to pay mortgage insurance if you put less than 20% down. As far as what that number could be, it will vary depending on several things, but some of the major things are what your credit score is, how much of a down payment percentage you're putting down, and then how much of a loan amount you're taking on. Because that mortgage insurance is covering the cost of default, so that risk of default will change depending on any of those three factors. As far as what that number could be, it could be as low as $30 a month if, say, you're at a 15% down payment and you have a $300,000 loan amount. Or it could be as high as $300 to $400 a month. So it will vary. This is the actual number that this particular lender is providing based on this particular scenario. But any of those factors, if any of them change, that number will change as well. Principal and interest of $4,160 is the final component there, and that's based on a loan amount of $617,500 and an interest rate of 7.125%. Again, that's not an advertisement for that rate. You're not necessarily going to get that rate just because you come to get a mortgage today, but that is an actual number based on the assumptions we've put in to create this quote. And either way, it is a pretty good sense of where rates are at right now. We're at the kind of the high sixes, low sevens if you're close to this scenario. And again, the main determining things going into that are we are 5% down, $600,000 loan amount. This is a 30-year conventional loan, and then 740 credit score. So let's pop down to the closing cost. Closing cost of $10,718. You're probably familiar, beyond your down payment, you're going to have to bring closing costs to pay for various things when you get your loan. There's two general buckets of two general components of closing costs. One of those is just what you would expect. You have to pay people and services involved in helping you get the loan and helping you get the house, things like your appraisal and your inspection, the escrow company, various things like that. And then the other main component is what's called prepaids. And prepaids are basically costs you're going to be paying on an ongoing basis as part of your monthly payment, but typically you'll be closing on the loan a good bit in advance before paying your first monthly payment. And so you still have to pay some of those costs. And so the way the lenders take care of that time before you start making monthly payments, between when you close on your loan and you start making monthly payments, is they have you put some of that into closing costs as prepaids. So that's things like your insurance, your taxes, and some prepaid interest as well. So your closing costs plus your down payment of 5%, all of that together means all the cash you're going to have to bring to close this deal, to put into escrow for this 5% down scenario, is $44,413. All right, let's walk through the 25% down scenario and see how the numbers change. So now the monthly payment drops down to $3,879, a little over $1,000 less per month. Right away you can see there's only 3 components now, not 4, because we no longer have to pay mortgage insurance because we hit that 20% down point, that 20% down threshold. Homeowners insurance and taxes stay the same because those are dependent on the house, not the loan amount or the loan structure. So those are both staying the same, $150 per month and $486 per month for taxes. And then principal and interest is now $3,243, based on a much smaller loan amount of $487,500 and an interest rate of 6.999%. The interest rate won't always change just because your down payment percentage changed. But in this case, going from 5% down to 25% down, we were able to get a lower interest rate. And a quick note on that, you may have noticed the section here, points or credit. Over here it's $7 of credit, over here it's $957 of credit. And that is basically, points are a fee you can pay up front in order to get a lower interest rate, and credit is the reverse of that, where the lender will give you some cash up front in order to take a higher interest rate. They cover some of your closing costs if you're willing to take a higher interest rate. So in both of these cases, we got a credit of $7 of a little bit. In this case, 7, and in this case, 957. And why are those numbers what they are? Why aren't they just 0? Why did I pick $7 and 957? Basically, I didn't pick these numbers. The way lenders generate and provide interest rate is based on a certain amount of points or credit. Typically, they have a whole rate sheet that they show various interest rates that you could get. Let's say all the way up from 8% down to 5.5%, and every increment along the way in let's say 8-point increments. And at each interest rate, they show a certain amount of points or credit that it would take in order to get that. So very rarely will they show one right at 0 points or credit. It just depends on what's going on in the market at a given time. But these are basically as close as we could get in each scenario to $0 of points or credit at the given time. So that's why they are what they are. But in this case, you'll notice we got a larger credit in order to take the interest rate of 7.125. So these weren't quite as different as they might seem, going from 5% down to 25% down, because we actually offset some of that with a $1,000 credit here that we didn't get over here. And then other closing costs, we now have closing costs of $11,397. And those are going to depend on on several things, but your loan amount and your purchase price are going to be very impactful on your closing costs. And typically, if you have a smaller loan amount, you're going to have lower closing costs. Over here, we have a smaller loan amount, but we have higher closing costs. And the reason for that is mostly because of this credit here of 957 that's offsetting some of these closing costs here. So otherwise, this one might be a little bit lower here, but we have that significant credit that's offsetting that. So your $11,397 plus your 25% down payment means all the cash you're going to have to bring all in order to close this deal is $175,092. All right, so how much income would it take to qualify for each of these loans? What income would you have to be making in order to get approval for these loans? So basically, for conventional loans, the way that lenders figure that out is they look at your debt to income ratio, or your DTI, which is your total monthly debts divided by your gross monthly income. and that number needs to be less than 50% in order to qualify for the loan, for a conventional loan, typically. And so what that means is this number up here, total monthly debts, they just take the new housing payment that you're trying to take on, whatever would result from the loan that you're trying to take on, and they add that to any other monthly debts you have, car debts, student loan debts, any other monthly debts. They add all that together and then divide it by your gross monthly income, which is your income before taxes. And if that number is less than 50%, then typically you will get approval for the loan. Now, a quick note, I'm not talking about budgeting. I'm not talking about affordability. This is not financial advice on what your ideal debt to income ratio should be when you're taking on a housing payment. This is just from the lender's perspective. If you came to the lender and said, can I have this loan? This is what they look at to figure out whether they would approve you for the loan. Whether you want to take that on is up to you. That's another question. So basically what that means is we just take this number, this total payment, and then we add any other monthly debts you have, and then multiply all of that by 2. And then if that resulting number is the amount of monthly income you'd have to be making. So I'm going to assume you have no other debts, no other monthly debts, and then take this and see what the income would have to be. If you have other debts, you can just add that up here and see what that number would be. So in the 5% down scenario, we are looking at $9,890 per month they'd have to be making, and in the 25% down scenario, $758 per month that you'd have to be making in order to qualify for these 2 loans, and that's monthly income. And if you are applying with a spouse for that loan, then that could be your combined income, but it does have to be income that the lender approves. So sometimes if you have various pay structures, if you work variable hours, or if you're paid on commission, or if you're self-employed, the way that the lender determines your income is not always super straightforward. So the number that is used down here has to be whatever they deem usable, which is sometimes different from what you have in mind. So just be aware of that. But if you do want to get a look at your income and see how much you could qualify for, how much of a loan you could take on, or if you just want to get a quote on a house that you're looking at, feel free to reach out. We have all of our contact information in the description below. We do loans in Washington and Idaho, and we love working with new clients, so please do reach out.